Hi everyone, welcome back to the channel. This video is a part of the monthly portfolio update series that is made for the individuals invested with me on Etoro. During Jan, the portfolio was up 23.9%, and for the year, we're also up 23.9%. We are currently invested in KWeb, Warner Bros. Discovery, Alibaba, Paramount, Liberty Global, Heritage Growth Properties, and Tencent. I wanted to start off by letting you know that the performance this month could be considered as an anomaly. It is not normal to make over 20% in a single month. I believe that the reason we saw this performance is because of something called the January effect. The January effect is the tendency for stock prices to rise in the first month of the year following a year-end sell-off for tax purposes. Over the long term, these anomalies will not drive our performance. It is the underlying businesses, so let's take a deeper look at the companies we hold. I'm going to categorize our holdings into three baskets for ease of reference. The first is China Tech, the second is Media, and the third is Cash Equivalents. The China Tech basket is 45% of the overall portfolio and includes Alibaba, Tencent, and KWeb. The Media basket is around 32% of the overall portfolio and includes Warner Bros. Discovery and Paramount Global. The remainder of the portfolio is in Cash Equivalent basket, and here we hold Heritage Growth Properties, Equity Commonwealth, and Liberty Global. I'm sure that you're completely surprised by all the changes that you're seeing. I decided to replace Prosus in the portfolio with Tencent simply to remove the additional layer of management complexity. Prosus management has been selling off their Tencent ownership in order to fund buybacks and also reinvest those proceeds into ventures such as food delivery, classifieds, online education, and so on. These buybacks increase Prosus shareholders' exposure to not only Tencent, but the entire Prosus venture capital fund. To me, it makes a whole lot more sense to gain direct exposure to Tencent, especially in light of their recent divestitures of JD and Meituan shares. Prosus management decided to dump the JD shares that they had received right at the lows. This is a capital allocation decision that did not make a lot of sense to me, as they already had cash reserves from their recent debt offering and also from the sale of their business. The management has been aggressively trying to reduce their NAV discount over the last few years, but I think that this is a futile effort. The management should be focused on compounding the underlying business and not just the stock price. Holding companies almost always tend to trade at a discount to NAV, as it's quite often the case of management diversifying rather than diversifying. This was also true for Porsche SE, the investment holding company that controls Volkswagen. Back in September, we saw the historic Porsche AG IPO, which was priced at the high end of its expected range and has continued to rally higher. Unfortunately, the investment holding company, Porsche SE, the company that we were invested in, it has not fared as well. On the day of the IPO, Porsche SE crashed, which did not make a lot of sense since they were direct beneficiaries of the IPO. There is a clear mispricing here between Porsche AG and VW. VW is still a majority owner of Porsche AG, along with automobile brands such as Audi, Lamborghini, Bugatti, Rimac, Bentley, VW, and so on. Also, I don't envision a scenario where Porsche SE would just collapse its complex structure and then distribute the ownership of its investments to the shareholders in order to unlock value, which is why I sold out of the position and reallocated the proceeds to other holdings where I think the future prospects seem better. Starting with the Cash Equivalents basket, where we've got Equity Commonwealth, Heritage Growth Properties, and Liberty Global. Equity Commonwealth, very simply put, is just a cash shell that's controlled by Sam Zell. Last year, the company came close to doing a deal to merge with Monmouth Realty, but eventually got outbid by another company. I appreciate the discipline of management to not overpay in order to just make a deal happen. Equity Commonwealth is a great holding in a down market, as they would benefit in a scenario where real estate deals show up due to a correction in the market. Liberty Global controls telecom operators across Europe. This company is an absolute buyback machine. They've bought back up to 50% of the outstanding shares since 2017. Management has also given guidance to continue this at a minimum of 10% per year. It is a boring situation where we're getting a buyback yield that's better than bonds. Heritage Growth Properties is a complete liquidation play. Our average buy price here is $11.8. management has given guidance to expect $18 to $23 in the event of a complete liquidation. Previously, I have been invested in Heritage. I bought when the shares were around $8 to $9 or so, and then sold when it quickly ran up to $13. Heritage is a great position to have as a cash equivalent since it's quite range bound. Every time I'm able to buy the shares around the $10 to $11 range, I buy them, and then when it goes to around 13 to 15, I just take profits at that point. This is definitely not a long-term opportunity, as management is very clear about their liquidation plan. So I prefer to trade it opportunistically. The only reason that I've built a cash equivalent basket is to ensure that we are fully invested rather than trying to time the market. If we get an opportunity to add to our core positions, those buys will be funded by this basket of cash equivalents. Let's move on to our largest basket, which is in China tech. It seems like a large portion of our returns this year will be coming from the recovery in these Chinese tech stocks, which have been hammered over the last 2 years. Alibaba has multiple catalysts that could increase the dominance of its business, starting with the primary listing in Hong Kong, the continued international expansion, the growth in the cloud business, the recovery of its investment portfolio. The list just goes on here. A lot of those points are also true for Tencent. Both companies are expected to release their earnings soon, which I will be covering in a lot more detail in future updates. Looking back at the portfolio, the last two companies that we are invested in are Paramount and Warner Bros. Discovery. Our average cost basis for Warner Bros. Discovery is just over $10, as I was aggressively buying shares in December during that sort of tax loss harvesting period. The same is true for Paramount, where our cost is around $18.8 per share. The entire streaming and content creation space is going through a very radical shift, as companies can no longer fund very average content to just fill up their libraries using debt that was borrowed at extremely low rates. There has been a lot of criticism towards a decision that the CEOs of these companies have taken, but to me, this is all noise. The only focus of the CEO should be the ability to generate cash while managing debt. If they are able to deliver this over the next 12 to 18 months, both these companies have an extremely long and profitable runway ahead. With that, I hope you have a better insight about the portfolio. We are off to a good start this year, and in my view, all our holdings are quite undervalued with potentially significant returns ahead. I truly want to thank those who have been invested with me over the long term. And for any new investors who have joined recently, know that I have my own money invested right alongside yours, so we're going to have the exact same profits and losses. If you'd like to connect with me or chat to just ask questions or something, you'll have links to my Twitter and Instagram profiles in the description below. Thanks for watching this update and have a great day.